Y'all, imagine buying your dream home, thinking you've locked in your mortgage payment, then boom, a year later your payment goes up hundreds of dollars and nobody warned you. Yeah, it's real. And today we're reacting to a TikTok video of someone going through exactly that. So you don't have to. If you're new here, my name is Kay, giving you the real keys to homeownership so you can buy smart, stay ready, and never get caught off guard. Let's get into it.
My mortgage went up $1,000 and I am not okay. So let me tell you guys, for the longest time, people be screaming from the hilltop, home ownership is not it. Like, don't rush, don't rush. And I will just be like, I don't understand it because I'm literally chilling, like cheaper than rent. I was bamboozled. So let me tell y'all what they do not tell y'all about real estate. So they do an analysis every year from at least with the mortgage that I got, right? And so they did an analysis and basically my mortgage increased by $1,000. And I asked them why. And they were like, something about my house is a new build. And so I guess they charged me for the taxes when it was just the land for 2 years. Then after year 2, they add the taxes with the house actually on it. And they were like, yeah, your builder is supposed to tell you. They didn't. They didn't. And so I asked them, can I sell the house? And they were like, there's no equity in it. You guys see me smiling, but come next month, I'm literally going to be in tears because $1,000 extra a month, I legit want to move back home and live with my parents. But I don't have that option. I'm sick. Like, I'm sick. Honestly, don't buy a house if you're single. Like, buy a house when there's 2 incomes coming in because, baby, you gonna need it. My mortgage.
Okay, so let's unpack what actually happened here because a lot of homeowners find themselves blindsided by this exact situation. When you make your mortgage payment, part of that goes into your escrow account. And that account is made up of your homeowner's insurance and property taxes. But here's the kicker. Those premiums and prices can change every single year. Every mortgage servicer does something called an escrow analysis, which is the official term. And this is a yearly review of how much you've paid in insurance and taxes the current year and how much they expect to pay in the upcoming year. So if your taxes or insurance goes up and you don't have enough money to cover that, that's what's called an escrow shortage. And guess who has to cover that? Yeah, you guessed right, you do, which is why your monthly payment goes up. Now, if you bought a new construction home, this hits even harder because when the home is brand new, the county typically taxes the land only, which is the official term for that is the unimproved value. But once the home is built and the county reassesses it, they start taxing the full value, also called the improved value. And yep, that tax bill can double or even triple. Also, if your lender based your escrow amount off of the lower value or that unimproved value, that first year payment might feel great. But once that escrow analysis catches up to the true cost, it's a wrap. And that's what happened in this video. Now, as she stated, she asked if she could sell, but they told her she didn't have enough equity built up in her property. And that's where it gets even trickier. If you're thinking the payment is too high and I'll just sell it, hold on. To sell your home, you need equity. And that's the difference between what your home is worth and what you still owe on it. But when you buy new construction, especially if you put down a lower down payment, there's a good chance that you don't have that much equity built up yet. And remember, selling houses costs money too, about the same amount that it does to buy a home. Usually 6 to 10% of the sales price goes to commissions, fees, and closing costs. So if your equity is not enough to cover all of that, you could actually end up owing money just to sell. And most people don't have that amount of cash just lying around. So what can you do in this situation? If this sounds like you, don't panic because you do have options. One of the things that you can do is to appeal your property taxes. Your county might have overestimated what your house's value actually is. That way you can reach out to them, appeal it, have them come reassess the property, see what the value is, which if you win, it could result in your tax bill going down, also resulting in your monthly premium being lower. You can also shop for cheaper homeowners insurance to lower that monthly requirement. You can pay that lump sum of money up front. It will eliminate your monthly mortgage payment going up as having that amount spread over 12 months. And then once you've built up enough equity or rates drop, you may even be able to refinance into something a little bit more manageable to help you lower down that monthly payment. Lastly, but certainly not least, you have the option to tighten up short term. Now, I know this one isn't fun and it kind of sucks, but adjust your budget to the extra monies that would be coming out. Or if you can, bring in extra income until you're back stable and in control. Like I said, I know it sucks and it's not ideal, but it's also not the end of the world and doesn't have to be the end of you being a homeowner. Now, the thing I like to talk about most on this channel is prevention. How to avoid this from the start, okay? And this is where most of your power as the buyer lies. First, ask up front if your escrow is based on the unimproved or improved value of the property, especially if you're buying new construction. Because even if the escrow account will be based on the unimproved amount, if you know this, you can set aside monies for the inevitable increase in your mortgage payment that will come monthly. That way you're not caught so totally off guard. The second thing you can do is get a property tax estimate from your county using the finished home, which would give you, it's an estimate, but it's more definite than going with the unimproved value of the property. But it'll give you an estimate of how much annually you would need to pay once the home is added onto the property. And then you can work to set that aside either as a lump sum or to pay that increase monthly in the next year to come. You also can budget for a higher payment than your lender quotes you just in case, because you know that the value of the house has not been assessed by the county, so your taxes will eventually rise. And why not be prepared for that while budgeting for it so it doesn't catch you off guard? You also can, like I said earlier, shop around for homeowners insurance early in the process. When you begin your mortgage process, your lender is going to have you shop for homeowners insurance. During that process, you will just submit one quote, but don't just look at one company. Look at several companies. Therefore, if, say you go with Allstate, if Allstate decides to increase that next year, you can switch companies because you've already done the research. And last but not least, talk, ask questions, lean on your team and the people in your corner. Your real estate agent and your lender, you're paying them. They're there to help you. It's better to ask more questions than not to ask enough. And ask until you understand, because these are big lifestyle changes and effects that may come a year down the line. And it's just better to be more prepared and to know what's going to happen instead of everything catching you off guard. When you know better, you buy better, and that's what I'm here to help you do. So if this video opened your eyes or made you say, why didn't anybody tell me this? You're not alone. And that's why I make these videos. So be sure to hit that subscribe button, watch this video for more homebuyer tips worth knowing, and drop a comment below if you've ever experienced a payment surprise like this or know of anyone who has. Until next time, see you in the next one.